What is up, everybody? Hope everyone's doing well. This is Brandon with HBG Capital. Today, I've got Tom Lonnie here today with me. I'm excited about this. I've actually known Tom for several years, and I run into him at a ton of meetups, masterminds. It seems like we're on similar paths here, and we know all the same people. Tom is the founder of Bulletproof Wealth, and today we're going to be jumping into a really exciting topic that a lot of people don't know that much about, and that is whole life products and what they can do. So Tom, tell us a little bit about yourself, your background, what do you do, who you help?
Hey, Brandon, thank you for having me on. I'm really excited to be here with you, and I love getting to hang out with you recently in Florida. It was such a good time. I really enjoy the different masterminds and such that we're in together. But so I was in the music industry, Brandon, for 29 years. And during that time, I got preyed on over and over and over. In fact, 3 times in a row by fraudulent financial advisors. And 2 of the 3 of them ended up in jail, believe it or not. And really, the 3rd one should have been. And I didn't realize how being in the music industry really does expose you, because the general overall lack of financial literacy in that particular industry. I was a mix engineer and producer. It does expose you to a lot of the negative side of traditional financial planning. So when I had a high frequency hearing loss in one ear and was no longer able to do that job, I decided, hey, I'm going to go back to school and really take the bull by the horns and try to be one of the good guys in this industry that does not mislead anybody and really tries to help move people forward, and where what I say, actually is something that they can, there's no smoke and mirrors here. So what I do is I help real estate investors primarily. I do have some non-real estate investor clients, but most by and large, I help real estate investors try to strategically position their money to be able to earn money like banks do. I know that's really a unique thing, and there's not a lot of people that do this kind of thing. So that is the main thing that I do.
So let's jump into that. So let's try to connect the dots here, because people think, whole life policies. Most of the time when people think insurance, they're like, oh, life insurance, I'm not going to die.
Yeah.
And then, banks, how to make banks make money. Connect the dots for us. Like, how do the banks make money, and how does that tie into insurance? And maybe talk about, how that's helping some of your clients.
So just so you know, the first thing we have to understand is that whole life insurance just happens to be the financial vehicle that, after years and years of study, I came across as the best place to create a privatized bank. It has all of the mechanics in place to be able to save money that you can then use like a bank uses. So let's just do this quick example. Brandon, if you deposit $100,000 into a bank, does the bank consider that $100,000 an asset or a liability? The reality is that most people think asset, but the truth is that because they have to pay you interest on that deposit, they consider it a liability, right? That is something on their balance sheet as a liability until they get a loan. When a borrower comes along and they take a loan for $100,000, that converts on a bank's balance sheet to an asset. So you have to think in terms of what really is an asset and what really is a liability. And I believe an asset brings money to you and a liability takes money away from you. That's a really simplified explanation, but in general, if you just go with, is it bringing me money or taking money away? That's how banks view it, right? And so what I'm doing is I'm helping people understand the mechanics of what it really is arbitrage. So if a bank is getting paid 5.25% on a $100,000 loan, and they're turning around and paying 0.25% to the person who deposited it, what is the rate of return the bank is making? So if they're making 5.25% from a lender, and they're turning around and paying 0.25% to the depositor, what are they making? What's your wildest guess, Brandon?
So they're making right at about 5%, right? They're arbitraging the difference.
Yeah. So here's the thing.
$5,000 a year.
So if you look at the actual numbers on a rate of return basis, they're paying on $100,000, $250 for that 0.25%, and they're making $5,250. Yes, that would be a 5% rate of return if the bank was using their own money, but they're not. They're using their depositors' money to lend. That is exactly what's happening. And what do they do with their own money? Well, they put billions and billions and billions of dollars into the same product that I'm talking about, which is whole life insurance. They even have a classification for it called bank-owned life insurance. So the reality is, if you get a $250 investment returns you $5,250, that's a 2,000% rate of return. And when that light bulb goes off as to what is really going on behind the scenes with banks, I'm trying to figure out how to duplicate a banking structure without having to have a banking charter. And the way that I did it was by creating like this overfunded whole life mechanism that you put more money in right up into the maximum the IRS will allow for it to still be considered life insurance. So you put this maximum amount of money in for the least amount of life insurance, and then you can borrow against that equity and put it into pay a low interest rate and put it into a higher earning interest rate deal. And then you're making the spread just like banks do. So for example, if I'm paying 3% and making 9%, right? That would be on a $100,000 investment. That would be me paying $3,000 and making $9,000. So on a rate of return basis, 3 to 6 is 100%, and 3 to 9 would be a 200% rate of return. So it turns, by doing the strategy properly, a low return of 9% into a 200% rate of return. Does that make sense?
Yeah, no, that makes sense. And then again, that's the term infinite banking that's coined, right?
It is, man. It's the infinite banking is what a lot of people call it. It is it's one element of my bulletproof wealth strategy. I add a lot more to it because I'm not a traditional just doing infinite banking. I have 3 financial designations. I've been through just massive amount of tests and courses and stuff. So I actually take a little bit more of a holistic approach to my strategy, which is why I call it bulletproof wealth. But the core of it is structuring life insurance to be able to use like a line of credit. And the closest financial vehicle out there to it is a home equity line of credit that people can understand.
Yeah.
So if you think of a home equity line of credit, if you had a $500,000 house and you had a $200,000 home equity line of credit going on, if you took a loan from that line of credit, you would be paying the interest and you would be putting it into an investment and you would be making the spread, just like what I'm talking about. Well, the problem with that is that when you do that, number one, it hits your FICO score. So it's going to reduce your credit rating to be able to do that, which my product does not do that. Number two, the bank that you're taking the home equity line of credit from is never going to pay you anything because you're just using the bank and paying them interest. Whereas in a whole life policy, you're actually getting paid dividends every year, whether you use the money or not. And so it's a phenomenal way to have compound growth that you never give up the rest of your life. It just keeps going, 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 going. Every year it's compounding inside the policy. So you're really capturing all of your opportunity cost by doing this strategy. And the third thing that is really important, besides the other two things, that I mentioned, is that with a home equity line of credit, it never goes up in value. All right. It just stays the same. The only way to get it to increase is to have your house reappraised, to go through full underwriting again and get them to increase your home equity line of credit. But with the life insurance line of credit, it increases every time you put more money into it. So I structure all of my contributions on an annual basis, which means you're going to have a larger line of credit every year. And it just works like there's no better place that I found to store money for the long term than inside of this product. I mean, Yeah, go ahead.
Let's break that down because you said a lot there. I think a lot of people can understand a home equity line of credit. This is a great example of what to
Yes.
compare it to. So they're like, oh, I've got this equity in my house that I purchased. I own this. This is a vehicle that I'm parking capital into, and I'm able to take an equity line of credit out and then use it for things. And as long as what
Yes.
I'm using that money for is making me more money than what I'm paying my
Right.
HELOC for, then it works. So how does this work? Let's say, I've got $100,000. I come to Tom and I say, hey, I want to take out this policy. What can I do with it? What kind of returns are you looking at in the policy? What do the contributions look like? And then
Sure.
how does it work if I did want to take some of it back out and then lend it on things?
So just like a home equity line of credit, you're never taking money out of your house. They're taking the equity in your house and collateralizing it and letting you borrow against that equity. That's all that's happening. Your house is still there. You're not chopping a room off your house, and you're never taking money out of your policy. That's the first thing we have to clear up. You're just collateralizing the equity and borrowing against it. That is the thing that is very difficult for the general consumer to understand, is that you're not using your own money. Just like if you took a home equity line of credit loan, you're not using your own money there. You're actually getting money from the bank, and they're just securitizing it or collateralizing it with the equity in your house, right? So if you put in $100,000 into a whole life insurance policy, how much you could borrow against or securitize would be dependent on so many variables that I can't tell you the answer to the question, because it's dependent on your age and your health. Okay. And then how you're structuring the contributions, which we can structure them to put in more money the first year, which gives you a higher access to your initial capital, and then less money every year after that, depending on if you just had a windfall, if you just sold a house, or you had a bunch of money come in, but you don't expect that to be in next year, or if you're going to be able to contribute $100,000 every year. That's a different design. Okay. So the thing with it, let's just use an example of putting in 100,000, and then every year after that, you're going to put in 50,000. So maybe first year you're putting in 100, and then year 2 on, you can put in 50. Well, the first thing is that I never structure it to where you would always be required to make a $50,000 contribution in those following years. You might only be required to make 30 out of that 50 or 25. It just depends on your age and your health. But there's a cost of insurance or a cost to structure this thing that comes into play. And that, again, is just based on your personal life situation. And so on a $100,000 contribution for a healthy person, say in their mid 30s, to mid 40s, you might be able to get $70,000 as a collateralized loan against the equity in your policy after 30 days. So you're going to have maybe 30,000 of it initially locked up inside this policy and 70,000 available. That's just a guess, based on just trying to give you some idea of what it might be. And then the following year, you might be required to make a $20,000 or $30,000 payment, and you can put up to $50,000 in. Now, the cool thing is, Brandon, is initially you're going to have a slight drop in liquidity, but after about the 4th year, every penny you put in is going to be on a cash-on-cash basis available for you to borrow out, typically, depending on your health. But typically, if you put in $50,000 on the 4th year, you're going to have like $52,000 you can borrow against, right? So the cool thing is that it does not feel like you're doing anything but moving money around once you get into this. But it is a long-term strategy that eventually has a multiple, meaning you have way more, 2-3 times more money inside the policy than you ever contributed. Plus you've got this actual asset class of life insurance that you've purchased.
Now, you said something that a lot of people were interested in. You said that at some point you could have 2 to 3 times more wealth than the actual money that you contributed. Break that down for us.
So the longer you put in money for, which the traditional, I allow people normally to put it in through age 67. So let's just say that you started a policy right now. and you're 40 years old. By the time you're 27 years old, you may have contributed $1 million, but you might have $3 million inside your policy that you could have used all along the way for your business or whatever. Now, the beauty of it is that when it comes time for you to stop working in retirement, this is only one of two places that you can have money that can provide a tax-free retirement income as well, because of the incredible tax advantages of life insurance. So you would distribute the money out in retirement, like you could do it annuitized where it comes out every year the same amount and you never pay tax on it. And I would have to show you, one-on-one what that would look like, but you have a lot more money in there than if you were to just put it into a traditional savings account. So just to be clear, Brandon, the internal rate of return is not ginormous. It's like maybe 4 to 4.5% IRR over the life of the policy, but that absolutely kills what you could get in a savings account. And from a risk-adjusted profile, those two things are very similar. I think that life insurance is a safer place to save money than a bank, to be honest with you, because more banks go out of business than life insurance companies do, just to be fair. And the one that I like to use is 175 years old, and they've never failed to pay a dividend in that whole 175-year period. So you're not only building wealth, you're able to use it for your investing, and you're able to get this amazing tax advantaged position as well.
So it sounds like when you put capital into this vehicle, right?
Yes.
It's earning, 4 to 5%, per year, somewhere around that range. And then when you're gonna, it sounds like after year 4, then there's a 1-1 ratio, right? Almost where you can, almost get, whatever you've got in the policy. When you take out a loan against that policy, so it's still compounding. This is where I think the magic is this policy is still compounding at the 4 to 5% per year. And when you take out a loan against it, then it's still making you money. And then you've got this loan over here that's secured against this product that you can now go arbitrage. Can you speak a little bit about maybe how much the collateralization costs or those bank terms, or what are people looking to pay if they were to borrow against it?
I absolutely can. So right now from the insurance company, it's 4%. They declare that interest rate once per year in January, and they cannot move it up every month, right? They have to stick for the whole 12 months with whatever they declared in January. So right now, the cost of capital is 4%. So if you had an investment opportunity that was paying you 8% and it cost you 4% to do it, your actual return would be 100%, if that makes sense. And the one thing that I'm not factoring into that rate of return is the dividend, the internal growth in the policy. So you're on top of that, you're also getting continued internal growth in your policy. So it is, you pretty much nailed it. I mean, it is definitely crazy how it works. And there isn't anything else that does that. So comparing it to a HELOC, you're not getting growth in a HELOC. It's just access to capital. That's all you're getting, but it's not growing. There's no bank paying you money unless you happen to be a shareholder in the bank and own stock and they paid you a dividend. So it is unique in that your balance grows inside the policy and they allow you to collateralize it. Now, if you went to another kind of the next layer up is using an insurance-backed line of credit that you can get access to at a slightly lower rate, and you get slightly more collateral capacity with that, but you have to wait until your cash value is 100,000 or more. So a lot of people don't do that right away, but I have a lot of people that do start with 100,000. So in other words, they just contribute what they need to get that initial $100,000 of cash value, and then boom, we start this product where they get access to lower interest rates. Right now it's prime, and then with a floor of 3.25, and then as that cash value grows, it goes to prime minus, like prime minus a half, and then prime minus 1, and their top tier is prime minus 1.25. So you get lower interest rate, higher access to cash, and You don't have to then take a loan. It's just a checkbook. They give you an online portal and you just write checks, or you can have money wired if you're doing a real estate transaction. So that's a lot of mouthful there, but did that make sense?
Yeah, no, you broke it down spectacularly. Now, talk to
Good.
us about the tax advantage with this. I know that there's some tax stuff that this is beneficial with.
Certainly. It's not exactly, but the closest thing to it is similar to a Roth. So you're putting in after tax dollars. It has tax advantaged internal growth. And when you distribute it in retirement, it's taxed on a first in, first out basis, unlike all other investment products. So let's just quickly break down what that means. If you had a $100,000 investment that grew over time to $200,000, so you have your initial basis of 100, then you have $100,000 of capital gains. In everything else, when you distributed out 100,000, they would consider that the gains or the taxable portion of it.
Yeah.
And you're leaving your basis in. Well, with life insurance, it works the opposite. So if you have $100,000 of premium contributions and it grows to 200,000, when you distribute out that 100, it's considered your first money in your basis, and they leave the gains in the policy. Does that make sense? So you can pull out all of the original money that you put into the entire contract in retirement with zero tax consequences. Then what the beauty of it is that once you hit that basis, you now switch to using collateralized loans that just build up and build up and build up to the tune of multi-millions of dollars, and the life insurance pays them off when you pass away. The life insurance is the thing that pays off that accrued loan balance, so you never have a taxable event. It's absolutely phenomenal how it works.
Yeah. So talk to us about what are there minimum investments to get started? Is there a cost to get started doing this?
So the minimum investments, not really. I will tell you this, that if you come to me and say, I'm looking at, let's just say you come and say, well, I make $180,000 a year and I'm looking to put in $5,000 a year. What I'm going to tell you, Brandon, is that I have not done a good job of explaining the advantages of it, because where I know when people understand the power of this is when they come and tell me, what is the most amount of money I can run through this? Because this is not, I put in $130,000 and I don't have access to that $130,000. It's I put in $130,000 and I can get 100 as a collateralized loan within 30 days. So it's just a place to filter all of the money that you make. So we have all kinds of limits on how much a person can qualify for, and it's based on your age and your income. So they do what's called an equity, income multiple of however much you're making. So, and that depends on how old you are, how much life insurance you can get. And then they also limit how much money you can put into a contract based on your income. So just give you a quick analysis. Right now, we're looking at 25% of your income. So if you made $200,000, we could put $50,000 a year in. Now that does not include year one. If you have a bunch of money sitting in a bank account, we can move as much as you want in year one, because they're only looking at the affordability from year two on. So is there limits? No. In fact, I start with people who are not at all financially ready to do this, but just want to capture their insurable interest and give them the option to do it later. And we do use convertible term insurance for that. It's a special type of term insurance. And then when they're ready to take advantage of doing a banking system, then we just do the paperwork and we don't have to worry about doing anything else. So it's kind of like you get pre-approved in a way. Does that make sense?
Yeah, it makes sense. So it sounds like you look at there's multiple factors: your age, your income, your health, et cetera. And that'll.
Oh, I have to do a full analysis. Yeah. And this is not, it's something that I go through with every single person that does it and make sure you understand exactly how it works. And usually that the initial meeting is about an hour and a half, where I go through and break it down for your specific financial situation, exactly what you can qualify for. And we just talk through the whole thing. That's what I do.
makes a lot of sense. Now with real estate investors, because I'm a real estate investor and I know how this
Yeah.
works. And a lot of times we're working really hard to get our taxable income, quote unquote, down as low as possible to not pay taxes. And we do that through a lot of different strategies. I use a lot of depreciable assets, commercial loans, things we can do cost seg studies and reduce that down. How does that play into, what you're able to qualify for? If someone came to you and, they've got, equity and assets and they've got, income, but maybe their tax returns aren't looking hot because they're writing everything off. Like, how would that
Right.
play into the process with you?
Brandon, that's an awesome question. That really shows me that you're understanding all of this. The answer to that question is that I look at gross income minus business expenses. And I don't look at writing off everything due to depreciation, right? So if you're making $500,000 a year and you have $100,000 a year of business expenses, your net that we can qualify you on is $400,000. Now, if you went in and depreciated a building you had with a cost seg study and you ended up with zero, I'm going to add that depreciation back in for your qualification, because they're looking at what is the sustainable amount that you can contribute on a year over year basis. They're not looking at your very bottom line AGI, if that makes sense. So it is something that I work with real estate investors specifically to try to really figure out what's going on and make sure that you qualify the right way.
So huge advantage. You can still use all that income that you're writing off and you're
Yes.
pretty much good to go there. Now, I know This is a really popular product for protecting wealth as well. You want to speak on that?
Absolutely. Well, protecting your wealth. So the big thing is that your cash value is creditor and predator protected from an asset protection standpoint. In most states, it's 100%. There are some outlier states, which we would go over that on the call, where I have a map of the United States and I know exactly all the different rules vary on a state by state basis. But Tennessee, 100%, Florida, 100%, Texas, 100%. The main states that I do business in, it is 100%, Utah, 100%. There are some outlier states. California is not as good. It's the first $15,164, is all that's protected. So that's not that great, but some states are phenomenal for creditor and predator protection. The other thing is that if you get sick or hurt and can't work, one of the unique features that I add to this is what's called an enhanced disability waiver of premium rider, which gives you the ability to not have to pay your minimums for 6 years in your own occupation. And then if you still are disabled after 6 years, it reverts to any occupation, so you don't ever have to pay it. So it really is a wealth protecting vehicle. And then of course you've got the massive benefit of having a huge amount of life insurance. If something happens to you early, your family is going to be taken care of as well. So it really hits on so many different unique levels that it is absolutely there's nothing that works like this particularly does.
Yeah. Now there's a lot of nuances to it. And that's why it's great to hop on a call, because, something that is this complex, we're trying to do the best we can, kind of break it down today, but maybe to simplify things, because I understand things on a third grade reading level and I try to communicate them that way because that's how I understand it. Everything I do, I try to break down. Why don't you tell us a story, maybe a success story of a client that you've had that is successfully using this? What's their profile? How are they doing it? And, what's contributing to the success with this product?
So almost everybody that I work with is utilizing their policies to invest in something that's earning a higher rate of return than what they're paying the insurance company. I have one client that's phenomenally successful using their policy to do what's called transactional funding, which that's where they're basically just taking very short loans and then they're lending them for maybe 6-7 hours at a virtually no cost to them, because they're, again, not using their own capital. And then the transaction closes, they're making 1% to 2% on the whole loan value. So let's just make that up on a $200,000 loan. That's $2,000. And the cost of capital for them is probably like, $1.50 or something. It's just mind blowing when you get into the shorter the time frame that you have the money out for, the cost of capital is almost nothing. And they're making a huge spread. Now, you can't do transactional funding every day, but it is one of those things where it's a big win when it comes up. I have people doing regularly self-storage. Self-storage is a very unique asset class, and I have clients putting money into that. I have a lot of clients doing multifamily investing. I have clients doing commercial investing. And one of the coolest things that people do is for fix and flip. So for fix and flip, you need access to money for an unspecified amount of time, and you do not want to be paying interest necessarily while you're renovating a house. So if you borrow from the insurance company, there's no required interest payment. So you could work on renovating a house for 6 to 9 months and never pay interest. And then when you close on the house, you just pay the loan back. And you've been making money the whole time. So I can't begin to tell you how unique the advantages are of having your money positioned properly so that you can take advantage of a deal when it comes along.
Yeah.
Does that make sense?
This is very popular in the fix and flip world. Very,
yes.
Very popular. I know a lot of people who are using it.
Yep.
Tell us a little bit how somebody can get started. And then if they wanted to get in touch with you, how could they find you?
So I have a website called bulletproofwealth.info. So it's not com, it's info, bulletproofwealth.info. And what I do is when I go speak at different real estate investor events and whatnot, I record those talks, and you can go in and watch a library of really great educational talks that I've given all around the country to people. And when you do that, it's going to bring up questions because you'll watch me talk and you'll be like, okay, he said this. I want to make sure I ask about that. Just write down those questions. And then at the bottom of that video page, there is a place to book a time to talk with me. So that is what I do. Basically pre-educate as much as I can through watching some of my videos of me presenting to groups of people, and then book a time to allow me to show you how it would work for you. And that is all free to get access to that at bulletproofwealth.info.
Y'all head on over to Tom's website. I'm going to post it at the bottom of this email chain and this YouTube video, so you'll have it. Check it out. Sounds like a ton of free educational content to bring you up to speed on what this is and how it may benefit you. And then Tom's here if you need it. Guys, I appreciate y'all tuning in today. Tom, is there anything else that you want to tell the audience before we tune out?
I think that's everything. I just hope you guys have a great day, and thank you for having me, Brandon.
Hey, thanks, Tom. Good to see you. See you, everybody.
You too.